Hey everybody, welcome back to another video with Matt Money. It's your boy, Uncle Matt, Matt Money, Uncle Matt, whatever you want to call me. So today we're just going to talk quickly about how much I'm kind of receiving in terms of dividend income and everything like that. So I do get a good bit as to some specifics about the portfolio and what I'm kind of doing on the side to be able to sort of make this sort of income. And so to give you guys a rundown, so I'm making about $15,000 a year in forward dividend income. Now, lo and behold, that's obviously going to go down in the future with some dividend cuts expected from companies like Wells Fargo and some other energy companies potentially. But as of right now, we're looking at about $15,000 in dividend income, and then we're also looking at about close to another thousand or so in terms of non-dividend income that is coming from like websites and YouTube and some other things that I'm trying to do to help boost income from the portfolio. So let's just hop right into that. But before we do, obviously want to give a quick shout out to me and my boy Kyle from Passive Income Investor. We started a secondary channel where we do a lot of our live streams. Actually, last night we gave away $50 to Dead League. So congrats, Dead League. Happy to have you on the Rich Gang squad. If you guys also want to be part of the Rich Gang, we're planning on giving away $50 or more once we start getting a few more members into the club. We're actually thinking about starting off with 50 once every month and then actually starting to do 2 or 3 every single time. So it might even get to the point where we're doing a giveaway every single time we're doing a stream. But of course, we have to get some of the cash flow going first before we start giving back to the rich gang. So back to the actual video here. And zooming in a little bit, portfolio value is about $317,000. Like I mentioned, $15,000 in terms of dividends. And there's a whole bunch of numbers here on the left that I could really follow through with. But the two main numbers that I really want to get into is the $317,000 in the dividend portfolio yielding about 400 or 4.75% dividend yield, with the yield on cost about 4.79%. Now you see this 464. This is kind of like, it's a feel good number, right? Because I have the 401k, of which I'd say about half of it's invested in the S&P 500, the other half is in cash. And so if I were to kind of take that S&P 500 bit, this income would kind of go up, but I also can't access it, right? So can't access the 401k for quite some time. And I do have plans to roll that 401k over into an IRA so I can at least have a little bit more direction as to what it's invested in. Am I going to invest it all in, say, QYLD and get like $14,000 a year in extra dividends and stuff like that? Who knows? I mean, it's really up in the air, but I really don't envision it to be anything too different. I mean, I just plan on potentially rolling over to an IRA, taking out some of the contributions, because obviously I'm doing really well right now, and it's probably looking like I'm going to be able to retire before I'm 59 and a half. I'm currently 29, just turned 29, and things are going relatively well, and I don't think I need to necessarily wait for another 30 years before I'm going to be able to retire. I'd rather have that money now, have a little bit more flexibility with it, and maybe make some other things happen. So specifically getting into the companies that I'm investing in. So there's a big table there on the left, but I obviously want to just do a quick zoom in of what we're kind of looking at in terms of percentage allocation. So I do a really quick run over when I do like my monthly allocation and monthly like dividend updates and stuff like that, which I generally just did like something yesterday for the month of June, which I made almost $3,000. I made over 2,800 bucks from all the different sources, which we'll kind of get into in a little bit in this video. But what I really want to do is dive deeper into each specific sector a little bit. Obviously, we're not going to go through like each stock and stuff like that, but maybe cover with a little bit more in depth as to what my strategies are, so that way you guys can have an idea as to how I'm generating this kind of income at 29. Now, I know I'm not making millions, right? But at the same time, I'm not really any sort of different than any of you guys that are really trying to start up your portfolio. I started about 7 years ago, and so only thing I can say to you right now is if you haven't started, get started, right? I mean, same with websites. If you're thinking about building a website, you have a decent idea, it fills a hole in the system that you think it could be something that's filled, get started. You know what I mean? Like, a lot of this wouldn't have happened if I just didn't get started. And there is a part where you can kind of learn and figure it out, but there's also a part of failing and getting back up and trying something new as well. So I'm not just saying just like willy-nilly throw all your money in the market, but at the same time, it's just like get a little bit, dip your feet in, read some bits, listen to some people that are ahead of you, get some perspectives, hear a bunch of different perspectives, which is really important, and then kind of follow along with this video, and hopefully it'll get you a year or two ahead of where you should have been um, if you're just kind of getting started now. So hopping into the actual capital allocation by sector, I think everyone's pretty familiar, but I'll go in the clockwise motion starting at about midnight or noon, I guess, if you want to call it. So we have consumer discretionary. It's your companies like GM and stuff like that. You have your consumer staples, companies like your Pepsi and Altria Group and stuff like that. Energy, self-explanatory. I still want to condense this a little bit. I have BP, Shell, Exxon. I have some CQP, which is Cheniere Energy Partners, and I did have a few others like Phillips 66, Kinder Morgan. I've eliminated those, but I also have another BPMP midstream company, which pays a really healthy dividend, which I also might want to diversify out of as well. And it's not that I don't have a lot of money invested into energy. It's just right now it's heavily down. So this 13% used to be close to 40% at its highest, but I think this has obviously been hit drastically with what's going on right now, and I think it will recover. I'm not pessimistic on the energy industry at the moment. I just think it'll take some time, and there's going to be some transforming that goes on within the energy industry over the next 10 to 15 years. And so it's going to be a relatively interesting story to follow in those next 10 to 15 years. So that's all I'll say about that. Moving on to financials specifically, this is another one where I have about four big banks rather. Bryn Mawr Bank, JP Morgan, Wells Fargo, and Bank of Nova Scotia. And I like Bank of Nova Scotia, but for some reason, I'm just not feeling it, man. I did reveal it in one of my top 10 videos. I do have a decent amount of money in there, but I think in a couple months, if I see an opportunity to kind of divest out of this and use that financials to kind of allocate to different parts of the pie, it's going to be something that I do. I don't really have a huge fancy for financials, although I think it's probably up there in terms of my top 10. But I think right now, with what's going on, I'm going to continue to invest in it, but I think it might be an opportunity to invest this money into something that's hurting a lot more. So Bank of Nova Scotia for me, I'm only down like 4 or 5%, and I think that I can use that money into something else that's extremely impacted right now, and I could potentially have a greater return over the long run, which now we're kind of getting to that $15,000 a year in dividend range. It gives me a little bit more leeway to stop focusing specifically on the dividends and focus a little bit more on growth as well, because I'm obviously making sure that the dividends come in case I lose a job or something like that. So there's that. Real estate, this is obviously Realty Income, Stag Industrial, WP Carey, Cyrus One, which is a data storage real estate investment trust. And then there's another one, man, Starwood Property Trust as well, but that's a relatively small piece of this 17.5% pie. So that basically just sums it up there. It's also probably one of the higher income generating ones as well. We'll highlight that in just a moment. And healthcare, obviously that's your Johnson & Johnson's, your AbbVie in the portfolio. I don't think that there's any other big ones that kind of come to mind, but those are the two major ones. Industrials, this is your Boeing, this is your Caterpillar, this is your 3M. These are pretty big, well-known companies. And so when you actually roll this over to what it's paying in terms of yield by sector, it shows up pretty abysmally, and that's obviously because of Boeing. Boeing used to pay about a 3%, 2.5 to 3-ish% dividend, but obviously that has been suspended due to what's going on with the pandemic right now. So I would love to invest a little bit more money into industrials. I think that it's a relatively good long-term play. One specifically, so I'd love to get another railroad. I used to own Union Pacific and I never bought it back. It ran up really quickly and I sold it for a good profit. I think it was like 50-60% if I remember correctly. Now they're just killing it, man. They were like in the 160s, and I'm like, shit. I mean, I wish I kind of held, and they're always having to continue to raise the dividend because they're throwing off so much free cash. But anyway, information technology. This shows up as 5%, which is kind of under allocated throughout the portfolio. But I am investing a lot of ETFs, which obviously in the S&P 500, the NASDAQ 100 is heavily weighted towards information technology. So while I am underweight here in information technology, I can kind of make up for it a little bit in ETFs. Materials, that's your BHP. Billiton, BBL, ticker symbol, and then you have LYB, which I don't know how to pronounce, but it's a chemical company and has really good free cash coming from the organization, which helps definitely pay that dividend and have huge dividend coverage and a very low price to earnings ratio. Of course, that's going to be impacted by with what's going on right now, but I think in the future, people aren't going to stop needing to buy chemicals. I think LYB will be fine in the future. BBL, I don't think people are going to stop buying copper or tin. It might take a little impact with what's going on in the commodity pricing, but just like they demonstrated in 2014, 2015, company's massively resilient and has a very low debt compared to what it was before. They've reshaped the portfolio. I think it's a great company. Telecommunications, this is obviously AT&T and Verizon. Enough really said there. It's small, 5.3% of the portfolio. Don't necessarily know if I want it any bigger. What I might do though is sell some of the AT&T and move it into Verizon. Not that I don't like AT&T. I have about 300 shares of AT&T. I have nothing wrong with AT&T, but at the same time I feel like Verizon is also a really good company. I don't know. I'm kind of torn because AT&T I feel like has a little bit more of like a cable network presence with HBO Go now and DirecTV, and so anyway, maybe I should just keep quiet. Utilities rather underfunded for the entirety of the portfolio for sure. This is obviously Aqua America, or what's now called Essential Utilities, and what else is the other one, man? Southern Company is another one I'm just starting to kind of cash up on as well. So this altogether is a relatively small portion of the portfolio, about 1.2%, and we're continuing to increase it. So I have about 50 shares of Southern Company that is helping continue to up this every single month. Cash is about 4.5% of the portfolio, and ETFs are about 1.6. Highlighting over or running over to income by sector, it's relatively the same order, right? So energy, financials, real estate, those are all going to be probably the biggest pieces of the pie. You can see it's way over 50%, just those three alone. And if you consider consumer staples as well, it's almost 75%, just including consumer staples, energy, financials, real estate. And I think what a lot of that has to do with real estate, financials, and energy have very high yields right now, comparable to the rest of the S&P 500. But one thing that I've really started to think about pretty in depth is, in terms of the S&P 500, energy is a very small percentage of that. It's like 4% at most. And that kind of gets me thinking. It's just like, I know I'm heavily invested in energy. They have high yields. I work in the energy industry, so I know a little bit more about it. But at the same time, I'm just like, I think I'm just way too over invested in it and I need to diversify it elsewhere. And I've been saying this and I've been diversifying, but sometimes when you see some of these companies that you work with them, and you've, know some of the stuff that they're working on, you're like, man, this is an opportunity. But anyway, consumer staples, everybody kind of knows about that. It's 10.5%. Energy is 24%. Financials is 22%. Real estate's about 18%. Healthcare is coming in pretty healthy, 6.7%. Industrial is about 4.7. So that's obviously half of the capital allocation. You can see here 9.3 in terms of industrials for capital allocation. Half of that is really paying dividends comparably if you kind of look at the greater portfolio yield. Information tech is barely paying us anything. Then you have some materials in here, which is matching about what it is in terms of the capital allocation. You have telecom, which is paying about 6.5%. You have utilities, and you have ETFs that are all relatively low, less than 1%, if you kind of look at all three of them. So these three sectors, ETFs, I guess isn't really a sector, but ETFs, consumer discretionary, and utilities are all paying less than 1%. So just scrolling over quickly so you guys can get a good idea as to what like the yield by sector is here. Energy is by far the highest at about 8.5% yield by sector at the moment. So the money that's invested in here, the $43,000, we're getting about $3.6 thousand a year, so almost $300 a month coming from energy stocks. So that makes up a good chunk of it, right? About 24%, right? But it's about 8.5% yield, which is scary high. Normally you wouldn't invest in a company that's that high, but a lot of these companies are depressed right now. I think some of them are going to cut the dividend. Shell has already cut the dividend, so this actually was in the 9s, almost 10% range at its worst during this most recent downturn, and you're obviously seeing that start to correct, obviously because the prices are somewhat increasing, but also because you're starting to see some cuts as well. Consumer staples about 5.9%. You have financials about 5.3%. You have healthcare, which is about 3.7%. Industrials was about 2.4%, so it makes sense. It's 9% of the portfolio in terms of capital. So it's 29,000 rather, and it's only paying $713. I mean, it's not really keeping up to snuff with some of the other ones in the portfolio. Information technology, decent investments. Amazon's, Google's in here, but they don't pay a dividend, right? So it's unfortunate. I think there's another one in here, which is First Solar. I might get rid of that in the Roth IRA and use that to buy something else. Materials 6.2%. So this is obviously being held up by LYB and BHP, both of which have very high dividend yields. I'm not concerned about them. They have the free cash to kind of distribute and match this at the moment, so there's no fear in that. AT&T is mostly the one that is keeping this 5.7% up for telecommunications. And that's obviously somewhat offset by Verizon, but Verizon's right now isn't really that elevated because obviously it hasn't taken the impact that say AT&T and a lot of other companies have. So utilities 4%. This is like your WTRGs or your essential utilities, and your southern companies helping obviously raise this up to about the 4% range. About, I would say, 3/4 of this is my investment in Southern Company, and then there is a small investment obviously in WTRG as well. Cash accounts for about 1% of the yield. Obviously, this has been going down due to obviously the interest rates being cut, and then ETFs about 1.5%. That's QQQ, ITOT. So the impact between those two, I hope to get this one up a little bit as I invest in like QYLD to help get a little bit more income. It's a covered call ETF that I found out from my boy Jerry. So if you guys are interested in something like that, you can use it in your portfolio to maybe up a little bit. I think it's going to be good for the long term, but I'm trying it out before I really blow it up. Like I mentioned, like maybe I'll drop $147,000 in it. That would be great because if you think about it, the yield's about 10 to 12%. So, I mean, that would be pretty nice, right? That'd be like $1,000 or $1,400 a month in dividend income. But at the same time, it's like, well, who knows how risky that sort of thing is. But I don't think I would do something like that. I think that it requires a little bit of allocation in the portfolio to give it a test run, and then maybe I might up it up to 5% or something like that of overall in the very future. But for right now, we're just giving it a, what is it, 5% of the whole M1 finance portfolio. So I think it's going to be like 100, maybe $200 at most every 2 weeks or so. That kind of gets jumped in there, and we can see that how that kind of performs and it trades over the long term, and see if it deserves a larger percentage of the portfolio. So yeah, you can see that that's how you get the 15,000. And let's take a quick look at the actual forecasting of things and actually what we also do to get a little bit more side income. So this is 2020, right? So obviously when we're kind of looking at what we're going to be making for 15,000, that's all 2021. And reason being is because obviously we're investing more and more every single day into the portfolio. Every time we get a dividend, we're reinvesting that back in. As you can see, we're kind of on track here for about 13,800. Goal for the year is about 14,000. And what we also have here is obviously the money from YouTube, Shopify, and options income, which is something I'm new at for sure. Shopify is one that I really want to talk about right now. Shopify is something that we started, I would say, in October, November, December timeframe. Me, Kyle, obviously myself, also started like kind of just selling on my own on Shopify, and then with a little bit of help from Kyle, we kind of researched it, figured out a little bit more as to like how to refine it a little bit. Kyle did a lot of the website work for sure. I had some of the products aspect of things, and then we developed it into two different websites where Kyle developed a lot of the products for the second website. And so it's been very symbiotic, our relationship, being able to kind of go back and forth with each other and create a product that people are starting to enjoy. And so this is also another little plug for the Rich Gang. If you want to join, for sure, let us know. $2 a month, you get entry to all of our giveaways, a lot of discounts to all of our tools, one-on-ones, and access to some people that have over 7-figure portfolios, and our Discord chat, our WhatsApp group, and stuff like that. So make sure you guys check that out, and hopefully that can allow you to ask some additional questions, and learn and shave a couple years off of your learning curve. So Options income, doing a lot of covered calls. Haven't done a lot of secured puts yet. That's something I want to get into as well, because I do have about 5% of the portfolio in cash, and obviously cash is paying about 1%. So that being said, I would love to take some of that cash, see if I can get maybe 2%, 3% out of that cash a year rather than that 1%. And I think that that could be something that I could utilize not only just now to try to boost income, but in the future and get a little bit more practice. So once I do get a little bit more money, or I do go on the road and kind of make this more of like a full-time gig, I can get a little bit more income out of those secured puts and kind of put them to use. So one of the cool things I want to highlight for sure is we're getting to the point where $1,000 in dividend income is going to kind of become a minimum now. So we're looking at like 956 in the second month of every quarter, which is pretty crazy because generally speaking, those months were always lagging behind. And you can see that we're almost getting close to that $2,000 mark in the third month of every quarter, with March and September always being the biggest because I have some semi-annual dividend payers, specifically BHP, that really pay out in those months and kind of boost the income in the third and ninth month of every year. So it's going to be fun to reinvest some of these dividends and see this kind of go over the $1,000 a month mark for forever. But obviously, if you kind of look forward, we're looking at about $1,250 a month in terms of dividend income. And with some of these other things, looking at them, you can see we're kind of forecasting out an additional $900 a month, and combining those two, we're obviously way above looking at $1,000 a month. So we're looking probably closer to $2,000 a month on average. And if you could look down specifically for what we have for 2020, just right now, without options income for full year or anything like that, we're looking at getting close to $25,000 for the year, which is awesome. That's one of the goals that I've kind of added in mid-year. It might be a light goal. Maybe I could actually stretch this to 26,000. That would be cool. But we definitely want to hit that 14,000 for 2020. And then 2021, man, it's going to be tough with some of these dividend cuts. We're trying to get to $21,000 in 2021. It's going to be tough, man. But I think if I can also hit about 35K in 2021 for like options income, Shopify, YouTube as well, that'll be really cool. And I'm working a good bit to try to get that to happen. And some of this stuff, man, the way I kind of view it is you could look at it in different ways, right? I'm going to reinvest a lot of this money, but this is also money that like I feel like I wouldn't have to invest, right? If I wanted to kind of take a moment and live it up a little bit, go on a vacation for 2 weeks, 3 weeks, I wouldn't have to necessarily be like, oh my God, like I'm losing all this money or I'm spending all this money. It's just like, no, man, I got a cushion. Like I could use this as a vacation fund. You know what I mean? 24 grand in a vacation fund, or 13,000 or 14,000 in a vacation fund for the year that I can use, and that probably would be forever and grow probably anywhere between 5 to 10% a year. So just next year alone, if I were to kind of like let this refund itself, this 15,000 will grow to 16,000, then it'll grow to 17, 18,000 the year after, just based off a normal dividend growth that we're used to seeing from this particular type of portfolio. So it's a lot of fun. I do need to get a little bit more work done with respect to forecasting out for 2021, because the 21,000 is what we're expecting for dividend income, but kind of looking forward elsewhere. We need to do a little bit more work on it as well. But you can see just based off of this, I mean, the growth that we've kind of seen over the past 3 years, getting to 1250 a month in average dividend income is awesome, right? You're looking at these red bars, and then 2021 is these orange bars. In 2019, the year last year, was in this light blue. And you can see in some months, man, we're up over 100%. June, we were up over 100%, going from just under $1,000 to maybe it wasn't. Maybe it was like 80%. Let's scroll down. Okay, so June was 85%. So I can't complain with that at all. 85% growth, if you can kind of average that, is phenomenal. I'm generally trying to average about 50% growth every single month for the next 2 years, and then average it out to 30% growth after that. So that means 2020, 2021, trying to grow at 50%. So next year, obviously going from 14,000 in 2020 to 21,000 in 2021 for dividend income, and then 30% every year after that. So 30% of 2,100, that's what, like 26,000. Sorry, 30% of 21,000 is about 6,000. So it's close to like $27,000 a year in dividend income, and that's just going to keep building at 30% a year. It's going to be tough, especially because these numbers are getting huge now, but hopefully with reinvestment, it really starts to help as well. And you can just see how easy it kind of gets there, right? So these reds are for 2021 forecasts, and we haven't even entered the end, or this, we barely have even entered the second half of 2020. And you can see we already have 25% increases, and some of this is due to capital and reinvestment, and some of this is also just to additional capital that we're kind of adding in. June, you can see we probably are taking a hit, and this is probably from Shell or other companies here in 2021. But you can see we're definitely averaging over 50% for most months in 2020, and hopefully for the latter half of 2020 we can get these up to the 50% mark, so that way we can for sure hit our $15,000 mark in 2020. And then obviously we want to do the same 50% next year. So we're almost there with January for next year. March is about halfway there. April is a little bit over halfway there, but we're lagging behind in February and May. And June, obviously, we're negative at the moment, so I got to work on that. But if I can get that 50% increase, man, from now till then, I mean, you're thinking about it. That's going to be $2,000 a month in dividend income almost. I mean, 21,000 divided by 12, you're looking at about 1750 or 1850 a month in dividend income. I mean, that's the dream, right? That's when you start to have some real fun. 1250 right now is a good time, right? I can use that to help buy a mortgage on an apartment, or buy a mortgage on a single family residence, or some small apartment complex if I wanted to, and 4 or 5 units, and really have something to kind of a backup, if you will. So if I have a tenant leave or anything like that, have some additional income to help pay for those expenses and not have to come out of pocket. I would be willing to come out of pocket for sure, and I probably would come out of pocket, in terms of the real cash that I'm going to be using to pay, but it's not like this $1,800 in September is just not going to show up, right? So yeah, I might have to pay $1,300 out of pocket for my checking account for, say, like a single family rental or something like that, but I have another $1,800 going directly back in, reinvesting back into the portfolio. So net cash out of pocket, $500. If somebody were to, say, walk out on a single family rental, and the next month I might have somebody come right back in, and boom, I'm back to making $1,000 a month again. Or honestly, could just like use this money and help pay down the mortgage on itself, and just use whatever money that kind of comes from that rental check to just go right back into this portfolio. And it's like this portfolio is helping fund real estate at that point, or some other business, whether it's websites or this or that. So anyway, rambling on a good bit, just kind of wanted to give you guys a little bit of inner workings of what's going on here. And before I cut it off, let's just do a quick look here about the increases that we've had in total dividend income. I said I started about 7 years ago. That wasn't a lie. I made less than $1 in dividend income in 2013, and we have grown that substantially over the past couple years. You can see that we're looking at about, at the moment, 55% increase. The goal is 57% increase. So we're like $173 or $176 or $7 from the 57% goal of 14,000. We're obviously about close to 50% off of what we're looking for next year. So it's going to be a big jump, right? We're definitely trying our best. We're going to get to 1750 next year, then 2275 in 2022, 2957 or close to 3K a month in dividend income in 2023. So we're going to need a lot of capital to be added to the portfolio to meet those numbers. And depending on what goes on, whether I lean more towards websites or what have you, these numbers could be adjusted for actuals and stuff like that. But at the moment, I'm setting the bar up high. If I fail to meet it, hey, you know what I mean? It'll look really good. But as of right now, we need to add like another $124,000 in 2021 to kind of get to my goals. So it's looking like I need to get to work for sure and figure out a way to kind of get there. And in 2022, we're going to need another $257,000. But keep in mind, if I have this $24,000 and I'm kind of making in 2020, that's going to eat away at the amount of capital I'm going to need. I'm going to reinvest all the money that's coming from the dividend portfolio. So I mean, it does have a little bit of lag, obviously, because not all $15,000 is going to go in on January 1st of 2021. So you have to keep in mind that, where you have these reinvested dividends, but some of those reinvested dividends won't really see a full effect until a year afterwards. especially when you're kind of reinvesting in the third quarter or fourth quarter. You're obviously not going to see an impact in 2020 when you're investing in 3Q 2020 or 4Q 2020. You're reinvesting those dividends. You're really only going to start to see the full impact of compounding in 2021. So anyway, that is that, and I'm kind of just going to cut it off there. We're kind of looking at other ways to kind of add passive income to the portfolio. I do need to add this a little bit. I think I am missing one or two little areas that I can add in here that isn't necessarily showing up 100%. So I do need to take a quick moment. This obviously should be reading about 15,000 or so, and it's off by about $100. So no big deal in terms of percentages. That's way less than 1% off. So do need to do a little bit of work on that, but at the same time, we're looking pretty good, man. And we're hoping that it continues to grow and be on the up and up. And hopefully this is a good idea for you guys to kind of be like, well, if I get started now, you could obviously be at the point that I'm at or more, or, maybe my portfolio size is a little bit big for you, but it's all based off of percentages, right? So, you know, I'm probably covering about 50% of my expenses with this year in 2020 alone, on the normal expenses, right? I'm kind of on a different sort of circumstance this year where a lot of the stuff is being paid for by the company. But as I kind of go back to normal life, spending about $50,000 to $60,000 a year, it's going to be basically paid off half by some of these side hustles that I'm doing. And I can then use all that money that I'm kind of getting from my 9 to 5 job and spending it and reinvesting it into the portfolio or buying websites or something like that. It's going to generate me more of this income kind of coming in. So like I mentioned, really want to hop up the total monthly income. I'm not expecting this to go to $48,000 in terms of total income from like side hustles. I would expect it to kind of go to 35-ish thousand if the trend kind of continues. Maybe get this up 50% as well. But we'll see what ends up happening. I still have 3 more months before I start getting into my full 2021 goals. Obviously, it gives me an opportunity to kind of get another couple months under my belt, see some additional dividend cuts, and then obviously lay flat what my 2021 dividend goal is. I mean, you think about it, I made these goals in 3Q, 4Q 2019, and so far they're doing relatively well. I remember this, was at 10,000, 11,000 expected forecasted income for the year, and I didn't even have some of these columns in here. I didn't have Shopify, I didn't have YouTube in here, I didn't have the monthly totals in here, and so we're continuing to add different things to be able to increase this income and be able to hopefully give ourselves a little bit more options going forward. So anyway, guys, I'm just going to cut it off here, do a little bit of editing, and I'll talk to you guys in the next video. Peace.